All right, it's lesson time. Here we go again. Get your pens and pencils out because we're talking trading terminology once again on the show. One of the most common things we get asked about are individual terms that we use during the live show. And then people email in and say, what do you mean by this? Or what does that word mean? Or how am I supposed to actually do X, Y, and Z when I don't even understand what that means? So we're going to break down some more advanced terminology that we use when it comes to both trading in general and the overall stock market. Guys, let's get started.
Sure. Why don't we start with something pretty simple here? And I mean, it's simple to us and probably simple to a lot of you viewers. But again, something that you have to understand as an investor. And that's going to be, mine is going to be share buyback, right? We're going to talk about share buyback and then we're going to talk about splits. All right. So right now, share buyback. Chevron has a huge, share buyback program on, as does a lot of companies, Apple, Google. And what that is they're putting money to work. They are buying back shares that are in the market, either given out through the IPO process, giving out to the open market. And basically, it just means they go in and buy back shares. So what they're doing is diluting the total shares outstanding. The reason why a company would do this is A, to take back control of the company, which some of the examples I'm going to give, it's not going to happen, like Chevron and Apple and some of those. They're not going to take back control of the company. But what they're doing is giving less shares out there to trade, meaning that it's a bullish sort of a call. Because if the company wants to put capital to work, why not do it in the form of share buybacks? This is something that a lot of institutions look for companies to do. It shows strength in the company. It shows belief from a management side of things. And right now, Chevron is one of the biggest share buybacks. They've reinstituted it. You can see what Chevron's been doing here on a daily chart, if we can go to that. Big time movement upside here. They announced it, I think it was their last quarter, the quarter before. Chevron instituting back $3 to $5 billion worth per year of share buyback. So again, what that means is a company is going into the market and putting their own capital to work and buying back shares. I broke down here, this is for global share buybacks this year for 2021. So as you can see here, healthcare, the number one. So again, a lot of companies over this pandemic have been able to raise capital. They have a lot of cash. And really, if they don't know what to do with it, why not just buy your shares back? Put the money to work in the market. Finance, metal and steel, insurance. As you can see, technology's there. That's head by a couple big boys, that Microsoft, Apple, as well, Google, and then down. But you can see right now, healthcare very, very hot. And we just saw that with Biogen grabbing that rumor or whatever from Samsung. So a lot of sort of movement of shares around on the buyback front. So that's what share buybacks are. For me, it's a very, very bullish sign. I love being in names where not only am I buying the shares, but also the company themselves is buying it. And again, it does help. If you go in there and you buy these shares back, it does help your financials, obviously, when you take a look at that. The next thing I want to talk about was share splits, right? Stock splits. So you often hear of a company doing a stock split. The most obvious one here is going to be Apple. Apple's done it a few times. And again, what they're trying to do here is just bring the stock back down into a reasonable price, right? And there's not really any reason to do this other than if Apple just kept on trading at $500, then, it would be $1,000, it would be $3,000, it would be $5,000. And then mentally, as a trader or as an investor, you say, I don't want to get involved in Apple. It's too expensive, but it's not. They're not diluting anything other than they're giving you so if you own one share up here at 500, you now own 5 down here at 100, okay? Apple's was a 7-to-1 split, or was it 5-to-1? I can't even remember anymore. 500 back down here, 130. So 7-to-1 on Apple, splitting back down, right? Coming in, there was Tesla split as well, back to the downside, or 4-to-1 on Apple, sorry, all the way back down to the downside there. And all they're doing is giving you, the shareholder, more shares. So it doesn't have anything to do with market cap, anything at all. The market cap stays the same. Simply the shares outstanding increase 4 times, 5 times. We've seen it with Tesla as well. And then look, is it a negative thing for the stock? Not really. Apple now, reverse splits down here to 120. Now we're up to 179. So if you consider that, that's how high up the stock price would be. So for me, again, doesn't really mean anything other than psychological. But remember, you also now have fractional shares. So you don't have to worry. A lot of platforms now, like Robinhood, I believe, Wealthsimple here in Canada, will allow you to buy fractional shares. There's another kind of stock split here, and we're going to talk about Naked Brands because, you know, a lot of people say, oh my God, you know, Naked Brands was down here at 50 cents. This just happened recently. And I know it's true because our viewers, the same, let's zoom in here, same kind of response. So all of a sudden you're sitting there and you're long at 50 cents. You wake up the next day and the stock is like, oh my God, this is at $7 or $6, whatever it was. You're like, oh my, I've just made the killing. But no, you have not. This is the other way around. So it's a reverse stock split. So they're taking their shares from 40, 50 cents all the way up here in a 15-to-1. So whatever shares you own down here, the shares get divided by 15. So you own 15 shares, you now own 1 share, and you're long back up here at this price. So that's what a reverse stock split happens. And the reason why a company would do that is more like because they're in trouble. You don't want to stay below $1. The NASDAQ has listing requirements. Below $1, you can't be under there for a certain amount of days. So as soon as that does happen, that's why this tick right here basically goes to $1, right? And then it comes back in. Whenever that happens, they have to get approval. They get approval from the board to reverse split it to the upside. Normally that's negative. So even if you look at this, although Naked Brands today making a move, as you can see, it reverse stock splits up to 650, and then 3 days later, the thing's all the way back down to 5. So it's not generally a good thing. It's just adding, taking away shares from this company, the total shares outstanding, and adding them back. So you get that 15-to-1 split on Naked Brands. But there's stock offers, sorry, not offerings, that's share buybacks plus a stock split.
All right, I'm going to do a quick primer on futures because I primarily trade futures on this on the show anyways. When I can, and there's a lot of questions. I imagine most people that are looking at futures for the first time don't know exactly what it is, and they may have questions. So I just want to do a quick explanation here. S&P 500 futures. Now, when you think index or when you see indexes on TV shows or whatnot, everyone's looking at this price right here, the cash spot index, right? That's the actual price of if you were to put all 500 companies together and kind of create a little synthetic basket, this is what you have. This 47.92, that's where the price should be if you were to put all 500 companies together and do that. It's up 0.212%. But now, if you look over to the left of that screen here, this is the December contract of the exact same index, but as a futures contract, you notice a price difference. Now, as a cash composite index, you cannot trade this. So you have to create a way to trade this, and what the market has done, what has been done for the market is we have contracts on one side and we have the ETF or the spiders, SPY in the Amex on the other side. Now for the contract side of things, you'll notice that they're going to be very close in prices because of the way it's calculated, and they're also forward looking. You have 3 months until they expire. These contracts expire every 3 months and they have a value associated with them, right? So there's going to be slightly different changes and there are going to be adjustments. So they're going to be slightly different in prices. But if you ever need to know what you're looking at, you have something to trade the actual cash index, but in a way that's done as a contract that expires every 3 months. And if you need to know the expiration calendar, just go on CME Group. This is the website. Just type in SPY or type in the S&P 500 E-mini contract. You'll notice that this contract, specifically the H contract, the March contract, expires on March 18th. So the Thursday, the week before, you're going to have everyone move over to the June contract, and it happens every 3 months, right? And also, if you ever need more information on contract specs or the details on how these contracts are calculated and what their values are, just go into specs on the CME Group website, and you have the units, the times that they trade, because they have their own Globex platform to trade on, and what each point means. So they're clearly, it's not going to be a 1 point difference like stocks are. These are quarter point differences. Each tick is a quarter point. It refers to $12.50 per contract you take. So just be aware that when it comes to contracts, it's just a different way of being able to participate in the index as a whole. But if you are going down that road, you need to know the differences and how they operate. So I suggest you guys take a look at the CME Group website for more information.
All right, one more as we wrap things up here real quick. Beta, guys, want to throw that one out there. You might have heard us say from time to time, oh, this stock is a high beta stock, or the beta on this stock is actually quite low. And that means typically you're going to get more volatile moves. So beta is simply a unit of measurement that compares an individual stock's move to the overall index. So a stock with a higher beta is going to move one in the same or very similar to the overall index. A lower beta stock might get some outside moves, some larger, more volatile moves. So higher beta stocks, simply, the Apples, the Microsofts of the world, are going to move and also move and influence the index, whereas some of the smaller, low float, more volatile stocks will have obviously a lower beta as well. So there you go. Lots of good stuff there as far as more advanced trading terminology, guys.